Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Phil Mackintosh, chief economist at Nasdaq, to discuss if stocks are a better value now than they were at the beginning of the year. Phil, it's great to see you as always. Welcome back to Trade Talks. And let's start with a quick overview of market performance since the beginning of the year.
Yeah, I mean, it's been a really tough week. And because of that, we sort of thought we'd look back at what's happened so far this year. We've obviously had the war come in, we've had waves of COVID, we've had China's now got COVID with some things going on there. When you look at the stock market, it's actually been trending down since the start of the year. The last time we hit all-time highs was just before the end of December. And so the recent levels that we've hit are basically in line with levels we hit about a month ago. We've got the Nasdaq down 20%, which is technically a correction, a bear market, and we've got the S&P down 10%, which is technically a correction. If you look at the dispersion between the value and growth indexes, though, you start to see what's going on, because the value indexes are holding up really quite well, but the growth stocks have been sold off much more.
What's driving the shift in sentiment?
Yeah, I mean, it's a lot of things. With the fact that we've got COVID in China, a lot of the factories are shutting down. So people are starting to worry about whether that's going to slow the Chinese economy. The Chinese government actually just started doing some monetary stimulus. We've obviously got the war going on, but really, I think what's driving the sentiment in the market this week is the fact that the war is creating commodity prices to go up, which is going to add to inflation. We've been talking forever about the fact that inflation is going to add to interest rates. So the interest rates have been going up a lot too. Again, if you look back a year, we've seen the 2-year Treasury yield go from less than 0.2% to over 2.5%. I mean, that's a massive increase in interest rates. It's reflecting itself in mortgage rates. And so it's going to get affected in the discount valuations of stocks. But what's really starting to happen is people have seen rates go up that fast, and they're like, oh, normally when rates go up that fast, we get recessions soon afterwards. And so a lot of people are worried about the recession. There's some models that are saying we probably could have a recession in the next maybe 18 to 24 months, but that's a long way away. Doesn't mean that the stock market won't start to price it in, though.
But inflation was an issue prior to the war in Ukraine, and that conflict only added upside pressure to commodity prices, as we can see in this chart here.
Yeah, I mean, you look at the commodity prices were already on an uptrend even before the start of the year. We've ever since the sort of recovery from COVID, we've seen commodity prices going up. And obviously with the war, there's going to be a lot of shortages of some of the grains that are made in Ukraine, some of the industrial metals that are made in Russia and Ukraine, obviously energy, which comes out of Russia. And the prices of all of those have gone up with the prospect of shortages. And that's feeding through into inflation. It's definitely feeding through into inflation in Europe. It's helping hold our inflation up at the high level that it's at. And part of that is making the Fed consistently rethink just how fast and how far it's going to have to go by jacking up rates to start to tackle inflation. And that because the Fed is now starting to talk very proactively about that, people are worried about recession being caused by the Fed, or maybe that's the only way that the Fed will get inflation back under control.
And Phil, you had spoken about the velocity and how quick interest rates are rising. How does that impact stock valuations? Why is the market so sensitive to that?
Yeah, it's because, I mean, you've got choices with investments, if as much as anything else, but companies also borrow money. So as the cost of borrowing goes up, you basically want to earn more on every other asset as well, because you can put your money in a bond and earn more. And so what happens is the earnings of companies that are growth companies, which tend to come out, 5-10 years from now, have to really exceed a much higher hurdle rate than the amount of money you would have earned by being in bonds for that time. And so as rates go up, unless a company can grow earnings, typically its valuation comes down. And we've seen before, we've looked at some of the data points. If rates went up 1%, we sort of thought we'd see a 20 to 30% pullback in market valuations, which is roughly what we've seen after you account for the fact that the earnings have also actually been going up. And earnings have been going up, the latest run rate sort of 6% year on year, after last year being running at a 30% run rate. So earnings are going up, interest rates are sort of pulling valuations down, and they're kind of contra affecting each other.
And Phil, to wrap up here, the bottom line, are stocks cheap enough to buy? COVID had going on here. Are they cheap enough to buy, not only for investors, but it could be interesting for M&A activity down the road too, as valuations continue to move lower?
Yeah, that's one of the good news points about the market selling off a bit, isn't it? Is that stocks are definitely cheaper now than they were 4 or 5 months ago. But the fact that earnings are going up as well means valuations are even more attractive. If we look at this chart, though, what you see is the small and mid-cap stocks are actually pretty well priced even before we got into the latest sell-off. So they're arguably maybe a little bit cheap historically, but really large companies are still relatively expensive. Looking at the price earnings multiples that they've traded at, the forward price earnings multiples historically. So, obviously those companies are different companies than they used to be. It's all tech companies with actual earnings this time. It's not banks, it's not oil companies, but their price earnings multiples are still pricing in pretty good growth, and obviously not really strong interest rate increases going forward.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.